For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Well, the music started, and the intro guy has already spoken. I think that was me. And so, hey, it's time to start the podcast. It is Managing Your Financial Future. Welcome back to another program. Johnny Dean, your podcast host, here with Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I got to ask you this today, Professor, how's the voice holding up? Because last time, it was fine, but you were straining. So are we okay today?
I think it's okay. I'll maybe take a break every once in a while to get a little cough like that. But other than that, no, the voice I think is back. I don't have a 900 voice anymore.
All right, that's good. Okay, well, I was just checking because you did cough. But see, I can edit that stuff out. I can't edit out the one you just did, but later on I could do that. So anyway, nice to have you back. I'm always appreciative of your time. In fact, I think you were on you were on somebody else's podcast within the last week or so, were you not?
Yeah, I think it's actually a video vlog or whatever.
Oh, yeah, it was. It was a video.
After the fact, there were cameras in the room.
Nobody tells you that before, Professor Plum. It was pretty good. I did see the transcript of it because I do some work on those other advisor podcasts. But anyway, I appreciate you being here with me. Now, if you recall last time, for folks who listen to these podcasts in order, we took, I think it was 5 questions. Fairly common bucket strategy questions. And I again hesitate to call them basic, but they were somewhat basic questions about bucket strategies, mainly from people who are interested in learning more about it and don't know a whole lot about it. And I think we covered it very, very well. And as I was looking through more questions, I had said last time that I'd like to get into a little bit more sophisticated, not too sophisticated where people don't understand, but maybe a little bit deeper questions of the bucket strategy. And I'd had a couple that I had found at the end of the last episode or toward the end of the last episode. And as I was looking through over the past several days where between podcasts, I mean, Rick, I found a ton of great questions. I mean, going back, and this is only going back maybe 3 years. I mean, this is these are some insightful things that people are asking, and I imagine you get questions when you're meeting with people as well, and many of these questions may also have been that. I don't know.
Well, we'll see. We'll see what the questions are.
Yeah. So anyway, I wanted to get into those today, and we'll cover as many as we can because I honestly, I could probably do this for 3 or 4 episodes. We'll have to see what the reaction is with people once these episodes air. If they like it, we'll do more of this. But I think it's helpful to do this. So let's get into these some of these a little bit more sophisticated questions. The first one here is kind of sets apart the bucket strategy from other bucket strategies, at least the one that we talk about. The first question is, how do you determine the optimal length for each bucket's time horizon? Now, Professor, we've seen bucket 1 time horizons as low as 2 years. I mean,
we've seen people write about them as low as 2 years. I don't necessarily agree with that time horizon. And the whole idea is, what is it we're trying to accomplish with the time horizon we're putting into place? Bucket number 1 is an account that holds assets that's going to distribute principal and interest over a certain period of time. And that principal and interest is going to be very stable. It's not going to have, the ups and downs of the market, whether it be a balanced portfolio or a pure stock portfolio, because we never want to be put in a position where we're selling something when it's in a down position. So bucket number 1 has to last at least as long as we need bucket number 2 to be left alone to give ourselves a very good, high or guaranteed probability that we won't be losing money when we move it from bucket number 2 into bucket number 1. But bucket number 1 is only going to last X number of years because we're, as I said, spending principal and interest, we're drawing it down, and we're using bucket number 2 at some point in the future to refill it. So depending upon what you're funding bucket number 2 with will kind of dictate how long your bucket number 1 is going to be. I've seen different time horizons depending upon what assets are used in bucket number 2. Now, typical in the historical terms, and even in today's world, the typical bucket number 2 is, in many cases, a balanced portfolio. That's where the 60-40, 50-50 stock bond mix managed together, reinvesting all the dividends, reinvesting all the interest from the bonds and things of that nature into that portfolio. That's where those portfolios really work well. We're not taking any distributions from them. We're letting it grow, letting it go through its gyrations, whatever it does, for a period of time. How long should that period of time be? Well, what we do is we look at historical time periods and say, what were bad historical time periods? 2007 was not a very good starting point for a balanced portfolio if all you wanted to have was 2 years of bucket number 1. Because if you had 2 years of bucket number 1 starting in 2007 and you were relying on a balanced portfolio as your bucket number 2, well, that got you to 2009. And 2009 was not a good time to be selling anything that was in the market. The average balanced portfolio from 2007 to 2009 was down 25%. The market was down 40-some%. So it was just not a good time. How long did it take that balance, the average balance portfolio, to get back to even, or even what I look at is not just even, but to what I would have gotten in cash, in CDs and T-bills? And it took about 5.5, 6 years just to get back to where we would have been with a potential risk-free rate of return. So we look at bucket number 2 when we're using balanced or somewhat variable assets to be 7 years. Why 7? Because that's where that asset fits from a risk standpoint. I've also seen 5-year buckets where people used guaranteed fixed annuities that had like a very good return for 5 years. It was locked up for 5 years. They couldn't touch it because of surrender charges. So they put a 5-year bucket number 1 together. And then 5 years later, they knew for a fact that their portfolio had that guaranteed account coming due after its 5% every year return, and they used that to refill bucket number 1. So depending, as I mentioned earlier, it's depending upon what you're using for bucket number 2, you're using either a 4, 5, 6, 7 year time horizon for bucket number 3, and we just look at what is that underlying funding source for the replenishment of bucket number 1. How much risk are we willing to accept? How much time do we have to give it to act properly and give us the return that we want with, accounting for outside influences?
Time, of course, is key. And then that's part of this question is the time horizon. But the more time that you can buy for not just bucket 3, but bucket 2 and bucket 1 and all that stuff provide
bucket 2
you.
is one of the harder ones because bucket 3, we know there's never been a 15-year period of time when the market didn't do a positive plus return. One of the worst ones was the 73-74 downturn, which was 12.8 years to get back to what the risk-free rate of return was. So we're looking for bucket number 3 to have a 14 to 15 year overall time horizon. That's bucket 3. Bucket number 1 needs to support income for a period of time before bucket number 2 is allowed, and then bucket number 2 can refill. So we're looking at bucket number 1. How long does it have to last for? It lasts for as long as bucket number 2 is required to sit. And in our case, we're usually using 7 years, but it also depends on where we are starting in the portfolio or in the economy. If somebody came to us and cashed out their, pension or something in 2002, in 2009, when the market's already down 40%, 50%, well, we don't necessarily have to protect against the downturn and then wait for the recovery. We're already in the downturn. We just have to wait for the recovery. And so we can be a little bit shorter on our time horizons. I saw this back in 2022, where somebody had retired from their position and they had a rollover from a pension plan, and they didn't want the monthly payments. It didn't make sense to them for whatever reason, and so they had cash. And instead of doing a 7-year and 10-year, 8-year bucket number 2 and 3, we did a 5 and 5. Because we were already at the bottom of the market. It was towards the end of 2022. And so we took it and said, let's be a little bit more aggressive here because we don't have to protect against the first part of the downturn because it's already happened.
Well, so what to answer the question, just when you determine the optimal length, really what you use is a lot of historical data, knowing the 15 years for bucket 3 is historically been a good length of time. And then the 7 years for bucket number one and bucket number two, 7 to 8 years, depending, that will get you there, at least using historical averages. So, and that's really all you have to go on. But I think that's
not only historical averages, historical kind of worst case scenarios.
Yeah, that's what I meant. You're right.
That doesn't mean that we can't find a new worst case in the future, but based on history, we've never had a worst case that was worse than that. So,
well, that's what you have to go on, and that's helpful. Okay, here's kind of along those same lines, I guess. Another question that we've had, which I thought stuck out, and it's one that we don't talk a lot about. But the question is: are there any risks to the success of a bucket strategy, and if so, how can they be mitigated? You know, we often talk about how, the bucket strategy as we do it is a risk mitigation strategy itself. We try to, sequence of returns risks and all that kind of stuff, longevity risks, maybe certain behavioral mistakes, something like that. So what would you say are the risks to the success of a bucket strategy, if there are any? And then how can you mitigate that? Talk about the risks first.
Well, there's two main risks, and they're both rooted in the same source. One is you spend too much. And I've witnessed this from even my personal use and other people outside of not me personally, but personal clients. But people think that they can just keep spending and spending. You set up a plan with an expectation. Maybe somebody says they're going to spend $10,000 a month. I'm just making numbers up right now. And they go along, and then they go, well, I need some more. So they start spending 12, 13, 14, 15. And the next thing you know, they're spending 20, 30,000 a month. And based on the original portfolio, 10,000 a month was going to last, pretty much forever. You double or triple that, or, then it's just not going to work because you're spending too much money. And that's one issue. The other issue is the behavioral, as you mentioned, aspect of it. Even though they have a plan in place, the emotions may override, and they may start making poor decisions where they start saying, let's go more aggressive. The market's going great. Let's go more aggressive towards the end of 2024.
In bucket three, you're saying maybe, right?
Yeah. So they start shortchanging bucket number. Things are going great. I don't need 7 years in bucket number one. Let's put 2-3 years in bucket number one and go. Let's just go all aggressive. And then they always usually do that at the wrong time. People do the wrong thing at the wrong time for the wrong reason. Or on the other side, the market crashes. And even though they know they don't need to touch that money for another 8, 10, 12 years, they sell it because they just can't stand the losses. So the behavioral aspect overrides what the strategy is supposed to be doing for them. So they break the strategy, then they stop using the strategy. And I've gone back and done lots of different research and lots of different what-if scenarios. And it's not easy if you just do the strategy. It's not easy to break the strategy unless you spend too much money. Taking large lump sums because hey, I'm doing great, life's going great. Boom, taking too much by spending it all. The spending is the biggest thing that will break it.
Yeah, you mentioned those two, and I would really put
they're both rooted in the person.
Well, I would both put those. That's what I'm saying. I would put those in behavioral. I would not even put that necessarily on the strategy because it's
not the strategy that failed; it's the person.
Well, it's the deviation from the strategies, and I understand that things come up in life as you do.
Right,
you
have to build that flexibility into the strategy.
Yeah, and things do come up, but there are times when behavior overrides everything, and the strategy is supposed to mitigate those behavioral mistakes. But you can do what you want with your own money. So if those are behavioral and more on the user end of it, do you see any risks inherent in a bucket strategy? Like for example, there's a systematic withdrawal strategy. That's the one we do not like, and this is what the bucket strategy tries to combat. But there's a systematic withdrawal strategy that's out there where they rebalance. Take a 50-50, 60-40 stock bond mix. You need some income, so you sell a bunch right off the top, and then you rebalance, and that's kind of a systematic withdrawal. Now, if you ask me what are the inherent flaws in that, risks in that, and I would say, well, hey, there are a bunch of them. A sequence of returns stands right at the top. We've talked about on the show before. Yeah, so I guess my question would be: do you see anything off the top of your head that would be within the strategy that could result in a risk?
not to the strategy, assuming that the cash flow that the strategy is trying to create is a reasonable strategy to begin with. I had somebody just recently, they've got about $500,000 and they're in their young 50s. And they're saying, I need to maybe get $45,000 a year from this. It's like, that's a tall order. Okay. and that could very well break the bank because you're taking a 9% distribution. Yeah. The buckets can't overcome that. It's not going to work.
Well, yeah. And that's again, that would be something that you would never set up something like that without knowing. I mean, maybe you could do a 9% for a couple of years until, Social Security or large pension kicks in. But that's, again, goes back to the that's not on the strategy so much.
But this is not the strategy's fault. But that strategy will break because it's too rich. The spending is too high. And that's what I'm saying. The strategy is not going to fail based on a reasonable distribution. It's going to fail based on either individual behavioral issues or spending too much money, which is obviously the individual as well.
Well, and this is why I like the bucket strategy so much, and not just because I've been kind of immersed in it for the last 2, 3, 4 decades, whatever it is, but because I really haven't seen any inherent flaws in it. And that does not mean that there aren't any, and I don't want to suggest that because there's obvious risk. We could have a 30-year period of time where stocks are down, and it hasn't happened.
We don't know what the future holds.
Right.
We only know what has happened.
Yeah.
And based on historical aspects of what's going on, I mean, we could have a complete change of currency and monetary policy, and who knows what happens politically.
Yeah,
I don't think that's going to happen, but
I mean, so far it hasn't, but it doesn't mean it won't. So that's just something to keep in mind. So, okay, that's just a great question. I really liked that question. Here's one that talks a little bit about maybe you're going to. The answer has to do with spending again, but the question is: can the bucket strategy be adapted for people who prioritize leaving a legacy versus those focused only on retirement income? Now, we know that the bucket strategy is a retirement income strategy, cash flow strategy, if you want to call it that. It provides a cash flow and attempts to make sure that you don't run out of money before you run out of time. That's the goal. But there are those who have plenty of pensions, plenty of Social Security, or plenty of money that they can tap into, where they aren't worried anyway before they even get the strategy about having enough income. So they say, well, here's my issue, Rick Plum, is that I would like to, make sure I leave a strong legacy to my kids or whoever it is, doesn't matter, to my heirs. So can it be adapted that way?
Well, anything can be adapted any way you want it, but the problem is you can't do two things that are contrary to each other. If you have somebody who doesn't need any money from their portfolio, it's very easy to create a much larger legacy for their heirs because they're going to not take any money. Therefore, the money grows. You have more options. You can grow it, and you'll have better legacy. But for somebody who wants cash flow from their portfolio, the more cash flow you take out during your lifetime, the less legacy is going to be at the end. So you have to make a decision. Where is your priority? Is it the cash flow or is it the legacy? Because you can't have it both. You can't have a high cash flow and a high legacy, because the legacy, what's left over, the inheritance that goes to the kids, is a function of how you invest the money and what you do or do not take out of it while you're alive. The less you take out, the bigger the legacy will be. The more you take out, the less it'll be. There's no way around that, except for one thing. Maybe take a little bit more if you're healthy to begin with, and buy a life insurance policy and guarantee a legacy, tax-free, by the way, to the kids. Now, not everybody's healthy enough to do it. Not everybody wants to spend the money to do it. But that's one of the surest ways to leave a legacy of a specified amount. And it's tax-free if you do it right.
Yeah, and that goes into our old pension maximization strategy that we've talked about before. Pensionized income, pension. If you want to take the highest pension, maybe purchase a life insurance policy. But you have to.
It does require you to be healthy.
It requires you to be healthy. And you got to run the numbers to make sure that it makes sense, because you are paying premiums on that permanent life insurance. But yes.
And so you set your income, your buckets, your investment portfolio up to support the life insurance. And if you draw down the buckets a little bit more, the life insurance more than fulfills it. If you've done it, if it's designed right.
So the answer to that question is, can it be adapted? Of course it can be adapted. Different people have different needs. There are those who, as we said, just don't necessarily need any kind of guaranteed income
But if you're telling me I need a 6% distribution from my portfolio, and by the way, I want this to grow at better than inflation for my heirs.
Well, no, that's not going to happen. No. So that's why the question is more for people who just don't need to worry about income. We've got them from other sources, so I don't need to even take much, if anything at all, from a bucket number one. Good question again. Let's see. How are we doing on time? Oh, we're good. Okay. We got about 10, 12 minutes left here. Let me give you a couple more here if we have time to do these. This is one, let's see. Question was, how does the bucket strategy compare to flooring strategies that use things like annuities to provide protected income? Now, we don't really say flooring strategies.
Call it flooring.
No, but this was the question. So, Professor, if you would maybe just tackle this one for a moment.
Well, we integrate what they call flooring into a bucket strategy many times. In many cases, it depends on the individual. Not everybody needs to have their income floored. And what we've talked about in the past when it comes to protected income is what is your fixed budget? When we wake up in the morning, we have expenses, in the month, through the month. We've got, we got to save for property taxes, or we got to pay rent. We've got a mortgage, maybe not. We've got insurance. We've got basic gas and electric. We have expenses, whether we have any fun or not. We haven't even talked about traveling, seeing the grandkids or anything like that. We just have fixed expenses that we have to hit each and every month. The idea is that you really should have enough guaranteed income from some outside source other than necessarily your portfolio to cover those needs. If you have pensions and Social Security of $10,000 a month and you spend $6,000, you don't need to do what they're talking about, create more flooring income. You have enough income. Your guaranteed income covers all your expenses. On the other hand, if you've got $6,000, $7,000, $8,000 of expenses that you need to have every month, but your Social Security, and if you have a pension at all, maybe it's only $5,000. You need another $1,000 to get that monthly coverage. That's where you add a protected income potential product to your portfolio, so that you're floored. You've floored out your income, I guess is what they're calling it, and you build that into the strategy. Now you don't want to take too much of your portfolio to do this, but you do. If you use 20-25% of your portfolio to buy a pension, as people have called it, and then get your income covered, what we found is that tends to take some of that negative behavioral issue that people have towards the ups and downs of the market out of the equation. And people become a more rational investor when the markets do behave something different than expected. And they stay the course better, and they tend to get a better legacy for heirs down the line. So this goes back a little bit to your last question, having the proper strategy with the appropriate amount of protected income that can help your legacy. But integrating the flooring is part of the overall strategy to begin with. And I'm using their term. Integrating protected income is part of how you develop a strategy. You want to do the appropriate amount of guaranteed income, but on the other side, you don't want to do too much, because there's no reason to do more, because it's not the greatest rate of return, but it's a great emotional factor to help control the behavior. So yes, we do integrate what they call flooring into a strategy when necessary, not every time.
Well, what they found too, and I've seen this in different research, is that people who are spending money from an outside source, some kind of pensionized, whether it's an annuity or something like that, guaranteed source, they tend to spend that first
freely.
They spend it freely. Yeah, they do, because they say, well, I'm not really spending my money. I mean, you are, but your goal is to spend that down and put it on, let's call it an insurance company that's providing this, because that's generally who it is that provides that, and live off of their dime. And they're very happy to do that because they feel like they're spending somebody else's money. So when we talk about flooring strategies, we don't talk about that, but I know what they're saying. You don't really compare it to these strategies, Professor.
It's not one versus the other. It's not flooring versus buckets. They're all kind of the same, that you integrate them together.
Yeah.
Flooring is not for everybody, but for the people it is appropriate for, it should be part of your overall strategy, part of your plan.
Yeah, absolutely. Let's see. We got a few minutes left here. Let me find, let's see. This question, I believe we have answered or have talked about in the past. It doesn't need a huge answer, but they want to know, how do you factor required minimum distributions into the bucket strategy as people age into their 70s, mid-70s, and beyond?
Well, this comes to a couple different points, but required minimum distributions are, for most people, a non-issue because they need to take a distribution to live off of. So where are they going to get their money? Most of their money's in the tax-deferred retirement accounts, and so they draw the money from the tax-deferred retirement accounts to live, and by doing so, they're satisfying their RMDs. So when you do the first thing you do with the bucket strategy is calculate how much you need in bucket 1, 2, and 3. Then it's a matter of, okay, how long before we get to our RMD age are we already at the RMD age? Let's make sure that if we're taking income from the portfolio to begin with, let's take enough from the IRAs to satisfy the RMD, and then we can do tax strategy planning above that if we want to. So if you need $20,000 a year from your portfolio and your required minimum distribution is 18, well, bucket number 1 is going to be probably all IRA money, because that way you have the appropriate amount of bucket number 1, and it's also satisfying the required minimum distribution. Now, for people that have a lot of income that don't need large distributions from their portfolios, and they have large portfolios, specifically large tax-deferred accounts, I saw this one the other day. We do buckets based on income need, not based on the RMD, because the RMD does not have to be taken in cash. The RMD just has to be, an amount distributed from the IRA to create a taxable event. That's what the IRS wants, or Congress, I should say, wants. They don't care whether you spend it or not. So if you've got somebody who doesn't need to spend it, we were talking to somebody the other day, or yesterday actually, and they have about a $40,000 required minimum distribution every year going forward. So we set up a bucket, and they need nothing from their portfolio. Zero, not a zilch. And so we set up a cash distribution bucket plan equal to the taxes that they're going to owe on the required minimum distribution. And so on a $40,000 RMD, maybe they owe, $10,000, in taxes. So we're going to do $10,000 of distributions from bucket number 1, and we're going to do a $30,000 transfer of bucket number 3, not sell it, transfer assets from bucket 3 to the IRA to a bucket number 3 personal account. Well, in this case, it was a living trust account, but so we're still taking $40,000 out of the IRA. We're still taking $10,000 in cash, withholding 100% of it to pay the taxes, and we're moving $30,000 of money from the IRA to the personal account to satisfy the required minimum distribution. They don't want to spend it. They're going back to your question a little while ago. We want to build more legacy for the heirs, so this is a great way to do it. But they needed the money from the bucket number 1 to pay the taxes. They couldn't just take $40,000 of bucket number 3 and move it over, because that created a $10,000 tax, and that would have eaten into what their other income was, and they didn't have that much other income. So it was a great way. We killed 2 birds with 1 stone.
Well, when you get into required minimum distributions, that's kind of it's not a wrench in the strategy, but it is something that you really need to look out for, because
it's always incorporated in. And luckily for some people, the required minimum distribution age is going to move forward again in not so many years, in about 10 years.
Well, okay, now it's the max lay age is 75, right? Is that changing?
Right, but that doesn't happen for 10 years.
Yeah,
it's still 73.
Yeah.
For anybody turning 73 in the next 9 years. But if you turned 73, 74, or 75 10 years, 8 years from now, excuse me, it goes to 75. So anybody born in 1960 or later has a required minimum distribution beginning age of 75.
Hey, that's you and me, by the way. You barely made it. I gave it a few years. But we both got in under the wire, so that's pretty good. And who knows what RMD? I mean, they could raise it, they could get rid of it. I don't think they will. But anything could happen going forward. But that's a good question. And the whole RMD thing and strategy. I know, Professor, your answer might have been hard for people to really visualize and
it
follow.
It is always considered when doing the buckets plan, but it's considered People confuse RMDs with cash flow. RMDs do not have to create cash flow. They just have to create a taxable event.
Yes.
So the bucket itself is based on cash flow. How much cash do we need to spend on any given year? And we need that cash to be able to spend it. And we don't want it to be, we don't want to sell anything when it's down to spend that cash. And so an RMD does not have to be taken in cash. In fact, in years where the market's down, you can take stock, assuming you don't need the money. You can take stock that's down, move it over to your personal account, and then hopefully when the recovery happens, that recovery happens in your personal account rather than in the IRA. It reduces your future RMDs because you've taken a bunch of money out that didn't recover in the IRA. And then your assets in your personal account grow. And if you do it right, you get almost a tax-deferred treatment on it, because unless you sell it, you don't pay any taxes. Then when you die and leave it to your heirs, you get a step up in basis on it.
Amazing.
It works really well.
What you're talking about is you take stock XYZ that's in your IRA, and maybe it's down. All you have to do is remove it from the IRA. You take stock XYZ, you pay taxes on that, and now you own stock XYZ in your personal account. That's really all that is. It doesn't mean you have to sell stock XYZ. You just have to pay.
And so it's still bucket 3 in our game plan.
Yeah.
It's still a long-term potential growth asset. But you have a stock that was 150 at one point, just naming no names. Maybe at the beginning of last year, beginning of this year, it was 140, 150, and now it's 100. And to get the full amount out, you got to, maybe your RMD was $15,000, and you had to take out like 1,000 shares or whatever it was. Now you have to take out 2,000 or 3,000 shares because it's gone down so much in value. And then when it goes back up to 150, if it does, that's all in your personal account, not in your IRA. So you were able to help your IRA future RMDs that way.
It is, and it's better to have it in your personal account because you get much better tax treatment. I could do a ton more of these because now I've just run across a few more. I won't because we are out of time on this particular podcast. But depending on folks' reaction to this, I don't know that I'll do this again next week. But I would like to sprinkle this season that we're in right now, this podcast season, with a couple of more episodes where we kind of take these buckets questions and help clarify things that people are asking about buckets, because I really do think it's helpful. Without having any, these shows that we've recorded haven't aired yet as of today. They will have, obviously, by the time you're hearing this. But I'd be interested in people's reaction to this and hope that they find it, maybe they'll hate it.
So get back to the buckets.
But not that part of the bucket. Just get back to, why don't you get back to talking about, movies and, lines from famous films like Animal House or any one of those. So we'll see.
I actually tried watching that a couple of days ago.
Animal House?
And parts of it were really fun to watch, and parts of it were like, I can't watch this. It hurts. It
hasn't aged well. Let's put it that way.
Like, wow,
but
we thought that was funny.
Well, we did, and we kind of still laugh at it. But yeah, I get that. Listen, if you want to know more about this stuff, especially the bucket strategy, you can go to luciacap.com, LUCIACAP.com. And up in the upper right, you can search bucket strategy where it says search. Type that in, and you will find the first thing that comes up is our bucket strategy guide. Something you can download, of course, for free. Read it at your leisure or possibly your leisure and learn about the bucket strategy, things that we've talked about on this show. And many of these questions are answered in that particular guide, but it can give you the basics, and it can also give you the details that you may want to check out. So do that at luciacap.com. You can also find other guides we have up there. I've mentioned this many times. We have a Social Security decision kit. It's a guide about Social Security. We have estate planning. We have retirement income. We have a bunch of others up there. So feel free to look around luciacap.com for more information about all of this stuff. Also, subscribe to this podcast. As I try to tell you every single week, make sure you download this to your device every single week that we're on. Go to Spotify or Apple Podcasts and download it and have a listen. I really think you're going to learn something, as I do every single week and have for many, many years. Again, Apple Podcasts or Spotify. Let's see. Is there anything else? Oh, if you want to get in touch with Professor Plum or any of the Lucia Capital Group advisors, by extension, Professor Plum, 800-644-1150, 800-644-1150. They'll be happy to talk to you about your bucket strategy. If you don't know anything about it and you want some more information, give them a call. If you'd like a bucket strategy set up, the bucket strategy set up, you could talk to them. Again, 800-644-1150. Professor, you've done a great job once again. I'll give you an A+ on this. I really think, and I have not run across a buckets question yet that you haven't been able to answer, and I don't think I ever will.
Well, I've been dealing with buckets for better than 3 decades.
Yeah, I think you're kind of on the forefront of that. But who knows? Who knows? Maybe I'll find one. I kind of doubt it. But thank you very much. Appreciate it, Professor Plum.
You're very welcome, sir.
We will talk to you again next time. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.